here at Easy Street Capital, and today I'm going to be talking about the financing options available for real estate investors looking at multifamily properties and some key differences between traditional and DSCR multifamily loans. Let's jump right in. So first things first, I want to go ahead and sort of define exactly what a multifamily property is in the real estate industry. Essentially, it is any property with 5 or more units. Now you may ask, why do 2 to 4 unit properties with multiple families living in them not count as a multifamily property? Basically, this is kind of due to a rule, somewhat arbitrary, created by the quasi-governmental entities. Conventional mortgage agencies, these include Fannie Mae, Freddie Mac, and when you think about it, it really is kind of arbitrary. You know, how does a 5-unit property, a residential property that might be 4 units, compared to a multifamily property? Likely, there are not many differences between them, and consequently, many non-conventional residential loan financiers have branched out into this multifamily space. And DSCR lenders certainly fall into this category. At their introduction, DSCR loans were limited to 1 to 4 unit properties, but have since expanded into the multifamily range. Many DSCR firms lend for up to 8 or even 10 unit properties, like we do here at Easy Street Capital. Now, we and many non-conventional lenders also originate DSCR loans for mixed-use properties that are greater than 50% residential in nature. Now, when it comes to multifamily traditional versus DSCR loans, there are a few key differences. The overarching difference between these conventional and DSCR approaches is the approach itself to multifamily properties. DSCR lenders will structure their multifamily loans similarly to their standard residential DSCR loans. This means that the loans will be 30-year mortgages, either fully amortizing with a fixed payment throughout the term, or interest only, which loan payments only cover interest for the first 10 years out of this 30-year term. Conversely, traditional lenders' multifamily loans look very similar to loans secured by commercial real estate assets, like office, retail, industrial properties. These are usually 5 to 10-year terms with amortization on a 20 to 30-year schedule. This means that they will require a balloon payment at maturity, or a payment that covers the outstanding principal balance that hasn't been gradually paid down throughout the term of the loan. While balloon payments will increase an investor's loan payments and increase their cash flow throughout the loan's term, the balloon payment can create tremendous pressure to refinance or sell the property at loan maturity. Now, another important difference category is the calculation of the debt service coverage ratio, or DSCR, on DSCR versus traditional multifamily loans. DSCR lenders will calculate the ratio based off of the residential property formula, which is taking rent and dividing it by PITIA, or principal, interest, taxes, insurance, and HOA expenses. Meanwhile, traditional lenders will calculate DSCR using the commercial real estate formula, which is taking net operating income, or NOI, divided by the debt service. Using NOI instead of rent in the numerator includes many more expenses, and thus makes expenses appear larger and lead to a less attractive DSCR than residential calculations. Qualification requirements can also differ between DSCR and conventional multifamily lenders. DSCR lenders, including Easy Street Capital, will typically qualify with a minimum DSCR as low as 1 and maximum loan-to-value, or LTV, ratio of 75%. On the other hand, conventional multifamily lenders may have these type of requirements, with DSCR minimums of 1.25, not uncommon. Now, a final difference between DSCR and conventional multifamily loans is interest rate. The rule of thumb is that DSCR and non-traditional lenders will have interest rates that are a bit more higher than their conventional counterparts. However, because of more flexible lending conditions and longer loan terms, DSCR lenders can structure their loans to minimize investors' monthly payments to be similar to that of a lower interest rate conventional loan, such as using 10-year interest-only options. So that wraps up this video on the financing options available to multifamily real estate investors and how DSCR loans stack up against their conventional financing counterparts. Be sure to give this video a like and subscribe to Easy Street Capital on YouTube for more industry insights.